You pull up to a car wash. You tap your card. $10? Maybe $15 if you're going for the premium package with the tire shine you'll forget to look at. You drive through in about 4 minutes. You drive away. That is the most deceptively simple transaction in American retail. Because here's what you just participated in without knowing it. A business with operating margins that rival the most profitable tech companies on earth. A business that Wall Street has been quietly losing its mind over for the past 5 years. A business that figured out how to turn a commodity service into a subscription model. And in doing so, completely rewrote its own economics. The car wash industry in the United States generated $20.7 billion in revenue in 2025. $20.7 billion to wash cars. And by the end of this video, you will understand why a single well-placed car wash can generate more profit per square foot than almost any other retail business in the country. And why the thing that actually makes the money isn't the wash. Let's start at the beginning. In 1996, 47% of American drivers used a professional car wash. That number seems about right for the era. You washed your car yourself on a Sunday afternoon in the driveway. A bucket and a garden hose. Maybe a chamois, if you were serious about it. Today, that number is 79%. That is not a small shift. That is a complete behavioral transformation in how Americans think about car care. Driven partly by convenience, partly by drought restrictions in Western states that banned home car washing, and partly by something more interesting. People stopped having driveways they wanted to spend Sunday afternoons in. The result is an industry that has been growing quietly and consistently for nearly 3 decades, and that most people drive through twice a month without ever stopping to wonder how it works. So let's wonder. There are 4 types of car wash businesses in the United States, and they are so different from each other economically that calling them the same industry is almost misleading. The first is the self-serve bay, the coin-operated kind where you stand in a stall and spray your own car with a pressure wand. Average revenue, around $41,000 per bay per year. Low staffing costs, minimal overhead. These are dying, slowly but consistently. The second is the in-bay automatic, the rollover machine you see at gas stations, where you pull in, stop, and a mechanical arm goes around your car. These cost between $250,000 and $700,000 to build per bay. A well-run unit generates between $139,000 and $500,000 annually. Some achieve profit margins around 69%. Not bad for a machine that runs mostly by itself. The third is the full-service tunnel, a conveyor belt that moves your car through the wash while employees clean the interior, dry the exterior, and hand you back something that looks vaguely new. Average revenue around $1.8 million a year. The problem? Labor. Every person touching your car is a cost, and those costs compound fast. And then there's the fourth type, the one that is currently responsible for a Wall Street feeding frenzy, private equity bidding wars, and the most interesting business model shift in American retail service in the last decade. The express tunnel. An express tunnel is exactly what it sounds like. A conveyor-based tunnel wash, no employees touching your car, fast throughput, low labor costs. You pay at a kiosk, you pull onto the belt, 4 minutes later you're done. A well-located express tunnel can gross between $1.5 and $4 million annually. Operating margins of 35 to 50%. Let that sit for a minute. Most restaurants run on 3 to 5% net margins. Most grocery stores operate on 1 to 3%. A good express tunnel at a strong location is running 35 to 50%. The math works because the major cost levers that destroy other businesses, labor, inventory, spoilage, returns, barely apply here. The equipment does the work. The chemicals are used in precise quantities. There's no product sitting on a shelf waiting to expire. And once the infrastructure is built and the customers are coming, the marginal cost of washing one more car is extremely low. Per square foot, a high-performing express tunnel generates more revenue than most retail formats in America. More than a typical clothing store. More than a chain restaurant. Competitive with, and in some markets exceeding, fast food locations that have been optimizing their real estate for 50 years. This is why Wall Street noticed. But here's the part that explains why Wall Street didn't just notice. It went absolutely berserk. It's not the margins on the wash itself. It's what the industry figured out how to sell you instead. Think about the gym membership model. You pay every month, you go twice in January, and then not at all until guilt brings you back in March. The gym loves this. The gym is actually counting on this Your underuse is built into their business model. Now apply that exact logic to a car wash. For somewhere between $25 and $40 a month, you get unlimited washes at a single location. Come every day if you want. They won't stop you. They'll actually give you a nice sticker for your windshield and a mobile app so you feel like a member of something. This is the Unlimited Wash membership, and it has quietly become the most important business model innovation in American retail services in the past 5 years. Here's why it works so well for the car wash owner. First, predictability. A retail car wash, someone who just drives up and pays, is completely dependent on the weather. A sunny week in April drives volume. 3 weeks of rain in November, and revenue falls off a cliff. Members pay regardless. Rain, shine, sleet, your $30 clears on the first of the month. Second, frequency behavior. Most members wash their car far less than they think they will when they sign up. That's not cynicism, it's just human behavior. You buy the membership with the intention of washing weekly. You average twice a month. The car wash makes its money on the delta between what you planned and what you actually did. Third, lock-in. Once someone has a membership, they don't think about competitors. The decision was already made. Every wash is now zero friction. You pull up, the system reads your windshield sticker, the arm goes up, you go through. You're not comparing prices. You're not even really making a decision. You just wash your car. Mr. Car Wash is the only publicly traded pure-play car wash company in the United States. In 2024, their Unlimited Wash Club accounted for 74% of total wash sales. 74%. The majority of their entire revenue base is now locked in recurring subscription income. Across the industry in Q2 of 2025, membership revenue grew 15.2% year over year. Retail, meaning people who just pay per wash, dropped 11.9%. The industry is actively, deliberately shifting its customer base from transactional to subscribed. And here's why that matters beyond just the car wash business. Banks will lend more against a business with predictable, recurring revenue. Real estate buyers will pay more for a location with an established membership base. PE firms value it like a SaaS company, not like a car wash. The subscription didn't just change how customers pay for car washes, it changed the market entirely. Now let's talk about what it takes to actually open one of these things. Because here's where the business stops looking like a gold mine and starts looking like what it actually is. A capital-intensive infrastructure bet on a specific piece of dirt. Building a new express tunnel in a decent US market will cost you somewhere between $3 and $5 million all in. Let's break that down. The land comes first, and in most markets, the land is the biggest single cost. You need a high-traffic corner lot, ideally with 25,000 or more cars passing per day. Those lots in suburban markets don't go cheap. $1 to $3 million for the real estate alone is not unusual in a competitive Sunbelt market. Then the equipment. Tunnel systems run around $800,000 for equipment financing alone. Construction, utilities, permits, drainage infrastructure, add another $500,000 to $1 million on top of that. There's more. Building a new express tunnel today costs 30 to 50% more than it did 5 years ago. Equipment lead times are running 4 to 6 months for tunnel systems because the construction boom of 2020 through 2025 pushed demand for car wash equipment through the roof. Everyone figured out the model at roughly the same time. Equipment manufacturers couldn't keep up. Once you're open, the ongoing cost structure looks like this. Fixed overhead, wages, facility costs, runs roughly $55,000 a month before you've run a single car through. Water and electricity consume about 20% of your total revenue. Chemicals, the soaps, the waxes, the tire shine you actually do look at, add another 30%. That's 50 cents of every revenue dollar gone, just on those two variable costs alone. Then, lease or debt service on your real estate, insurance, credit card processing fees of 2 to 3% on every swipe. And preventive maintenance. Experienced operators reinvest 3 to 5% of annual revenue into keeping the equipment running. Because one breakdown on a Saturday afternoon, your highest volume day, can cost thousands in lost cars. Most new express tunnels reach break-even within 12 to 18 months. Full revenue stabilization, meaning you've built your membership base and your throughput is optimized, takes 24 to 36 months. The magic number most operators talk about is somewhere around 1,500 to 2,000 active members. Get there, and the base economics become very hard to shake. Here's where things get interesting. Because the car wash industry has a very polished investor pitch, and that pitch tends to leave out a few things. The first is weather, and not in the way you'd expect. The subscription model insulates you against rain, yes, but your membership conversion rate is built on the assumption that your customers want to wash their cars regularly. That's only true in dry climates. In Phoenix, in Dallas, in Denver, cars actually get dirty between washes. There's dust, there's pollen, there's road grime. You need a wash. In Seattle, in Cleveland, in Pittsburgh, your car is always either wet from rain or about to be wet from rain. The psychological trigger to wash your car just doesn't fire as often. Car wash markets in high precipitation regions are structurally smaller, and no amount of subscription innovation fully fixes that. Location selection in this business is everything. The second risk is oversaturation, and this one is self-inflicted. The car wash construction boom of 2020 through 2025 was driven by exactly the economics we've been describing. Everyone figured out that express tunnels with subscription models were printing money. Private equity poured in, franchises expanded aggressively, new operators started building. In some markets, there are now 5 or 6 express tunnels competing for the same customer base within a 3-mile radius. When that happens, volume drops at every location. The membership math that worked when you were the only express tunnel on the north side of town stops working when a competitor opens 6 months after you and starts offering a lower introductory rate to steal your members. Site selection in 2025 requires understanding not just current competition, but planned competition. Building permits are public records. Operators who don't check them before committing to a location have found out the hard way. The third risk is the one the industry mostly doesn't talk about publicly, and it is the most important one: debt. The car wash expansion boom was financed almost entirely on debt. Cheap debt during the period when interest rates were near zero, and then increasingly expensive debt as rates rose. The model of acquiring or building dozens of locations, leveraging each one to fund the next, works brilliantly when the cost of that debt is low and volume keeps growing. It stops working when rates rise, competition compresses volume, and your debt service starts eating profits faster than your membership base can grow. The cautionary tale here is Zips Car Wash, 625,000 members, around $303 million in annual revenue. The second largest car wash chain in the United States by location count. In February 2025, Zips filed for Chapter 11 bankruptcy. At the time of filing, Zips had accumulated $654 million in debt. Its cash balance was under $1 million. The unit-level economics at individual locations were often solid, but the corporate debt structure, built during an aggressive acquisition run, was not survivable when the macro environment shifted. High margins at the wash level do not protect you from bad capital structure at the company level. That lesson is now written in the history of the industry. Let's talk about what's happening at the top of the industry, because it explains where this whole thing is headed. Private equity has treated the car wash sector the way it treated gyms in the 2000s and coffee shops in the 2010s, as a fragmented, locally owned industry ripe for consolidation, brand standardization, and multiple expansion. The logic is straightforward. Find a business with strong unit economics, build a brand around it, acquire independent operators, convert them to the brand system, and then either take it public or sell to a larger PD firm at a higher valuation than you paid. In February 2025, Whistle Express Car Wash acquired 383 Take 5 car wash locations in a single transaction. 383 locations in one deal. The largest car wash transaction ever by location count. This is what the late-stage consolidation of a fragmented industry looks like. The majors are vacuuming up independents at scale, and the independents who hold out are either going to get acquired at a reasonable multiple or get squeezed by the chain's superior marketing budgets and loyalty infrastructure until they have no choice. For anyone owning a single location or a small regional chain right now, this is both an opportunity and a threat. An opportunity because a strategic buyer will pay a premium for a location with an established, growing membership base. A threat because if a chain opens across the street with a deeper marketing budget and a national loyalty app, competing on brand alone becomes very difficult. The franchise path exists for exactly this reason. Tommy's Express, Tidal Wave, Quick Quack, these franchises charge $35,000 to $50,000 upfront and 4 to 6% of revenue in ongoing royalties. In exchange, you get the brand, the systems, the supply chain, and the marketing support. You give up margin. You gain protection from exactly the scenario where a chain opens across the street. because you are the chain. There's one more variable sitting at the edge of this industry, and it's the same one sitting at the edge of every transportation-adjacent business in America right now. Electric vehicles. EVs still get dirty. Physics hasn't changed. But EV owners have different washing preferences. Many prefer touchless or soft-touch washes over traditional brush-based tunnels because of concerns about sensor damage and the various cameras and proximity detectors that cover modern EVs. Older brush-based tunnel systems may lose a growing customer segment as EV adoption increases. Express tunnels with soft cloth or touchless options are better positioned. This is a manageable transition for well-capitalized operators who can upgrade equipment. It's a harder problem for older in-bay automatic systems built around friction technology. The deeper question for the industry isn't whether EVs will stop needing washes. It's whether the driving behavior of EV owners, shorter daily trips, less highway grime, more time at home charging, changes how frequently they feel the need to wash at all. The data on that is still coming in. What's clear is that the operators watching the EV transition most carefully are the ones building for the next decade, not just the next quarter. Here's what the car wash business actually is, once you strip away the $10 transaction and the 4-minute conveyor belt. It is a real estate business that chose a car wash as its anchor tenant. The location is everything. The dirt on which you build determines 80% of your outcome before you've ordered a single pump or a single bottle of soap. It is a subscription business that uses the wash itself as a customer acquisition tool. The same way the gas station uses cheap fuel to get you inside the convenience store. The wash is not the product. The membership is the product. The wash is just the reason you show up, and it is a capital markets bet, financed heavily on debt, consolidated aggressively by private equity, and now working through the consequences of what happens when you grow faster than the underlying market can support. The people who built this industry over the past decade got something fundamentally right. They found a commodity service, added recurring revenue, and created an asset class where one didn't exist before. The ones who are still standing after the consolidation shakeout will have figured out the thing that always matters in any high fixed cost business. That strong unit economics at the location level are necessary, but they are not sufficient. The capital structure has to survive long enough to let the business breathe. There are 60,000 car wash locations in the United States. That number is still growing. And every one of them is trying to get you on a $30 monthly plan before you drive away. Now you tell me your thoughts on owning a car wash in 2026. Is it a good idea or bad? Also, write in the comment section about what next company or industry's economic model breakdown you want in the next video. Last but not least, check out these 2 videos breakdown if you have not already. Thanks for watching. Bye. I will see you in the next one.